enlighten me. When I don't know, take anything. I'm just trying to think as how someone in your position makes their money. When I go to a surgeon, they charge a fee to perform surgery. I don't know what cuts go where, but he makes his money and he goes on to the next surgery. Someone like yourself, you mentioned managing funds and things like that. How does that, is that similar to like a real estate agent where you get a percentage of a deal or of
when with the investable funds? Yes. So it can be one of two ways. And for me now, it's called assets under management. So it's a fee based on assets under management. But prior to kind of recent, it was one of two ways. It was commission based or assets under management. But recently we've shifted to mainly just assets under management. So whatever the value is, we get a small percentage, usually below 1%, that we charge the client to do those type of things. And that's typical across the board for most financial advisors. They're making a 1% on whatever assets you give them to invest.
So it's whatever assets I give you, not the appreciation of any of them.
No, have you ever heard of Fisher Investments?
No.
Their big thing is when you do better, we do better. So when it appreciates, yes, they get more. It's still the 1%, but think of $100,000 you start with turns into $200,000. Well, that 1% grows too. So their whole, Fisher does a great job marketing, because that whole thing, you do better when we do better, sounds great, but that's what 99% of advisors do anyways. They just it's a flat fee under certain things. Now, some of the big, box houses are a little bit different because like you can go out and you can open a Fidelity account on your own. Don't talk to anybody. Just go to Fidelity, type in all your information, and open an account. And on the surface, it looks like you're not paying that asset under management fee. But where they get you is, one, they call it sweeps, and you can have only so much cash you have to have in your account. So if you deposit $100,000, they're not going to necessarily just let you invest that $100,000 right away. They take some of that and they go and throw it in their bank, and then they lend on it. So that's how they make their money on the backside. So you're not really seeing any fees on that but they're making money on it. So that's how they're kind of generating some income. Then on the other portion, they only give you so many options to invest in. You get ETFs, you get mutual funds. They let you, depending on some type of an account, they let you do stocks and things like that. But that's where that sweep balance is a little higher if you do direct stocks. But most of the time it's ETFs and mutual funds. Well, those ETFs and mutual funds are the box house ETF and mutual fund. So they put it together. So inside there, they have management fees. So you're investing $100, let's say. Well, that $100, there's fees that are charged on that. You just don't see it with the way that they report the gain and loss and all that type of stuff. There's turnover fees, there's asset fees, there's all this type of thing that are going on within that. So the growth that you actually get with inside that is not a true indication of what you're paying for that growth. So that because they're so mass, they can manipulate the system a little bit more. So anytime you're investing anything, one, I always tell retail investors, you're the last to win. If a stock goes up, you're the last one that actually gets paid out or benefits from it. There's many people in front of you that have already taken their profits and won. And two, you're paying fees. No matter where you're investing, there's fees that are going out the door that you're paying. There's just no way around it. You can't be in the financial system this day and age and not pay some type of fee.
Right.
Now, I'm not saying that it's standard across the board or it's all equal, but you're paying a fee. I mean, that I think is the other biggest delusion, is that they think that they're not paying a fee. Or I'm going to manage my own. I'm going to open a Robinhood account. You're losing in Robinhood too. Like that's that whole controversy that ended up happening of them front running all the purchases and all that type of stuff. So you're not getting the price that you should get when you purchase it through Robinhood, because there's 20, 30 other people who are in front of you buying it before you buy it. So they benefit. Stock goes up, they sell out. So it's a small deal, but it happens, and no matter what you do.
It's funny you say that, because I actually recently heard there's like this famous saying, goes something like, if you think college is expensive, wait till you find out how expensive no college is, something like that. Basically to come and say that sometimes things that cost you a lot of money are actually overall the cheaper route than not doing those things.
Yeah.
And
Sometimes, yeah.
sometimes, some things.
Yeah.
I'm not saying I agree with that with college, but just like you get the idea. So when you talk about, or just in general, and I think about myself, when it comes to like financial stuff, I know for a fact that regardless of how much having someone manage all these things that I know little about might cost me, at the end of the day, it may very well be the cheaper way out than me trying to do it myself.
Potentially. Because that's kind of that my whole, intro at the beginning is not all people in the industry are the same. By you just giving money to a financial advisor and they're only investing in stocks and bonds and then charging you an asset under management fee, that's stupid. If all they're going to do is build you this portfolio of stocks and bonds and mutual funds or ETFs or whatever it may be, and then charge you an asset under management fee, that's not smart.
Why?
Because you have just as good what makes you better at picking stocks and bonds than me?
Maybe the trends of the market.
So yes, when you're in it a little bit, it's like when I always tell people when when your car breaks down, you don't fix it yourself because some things you just can't, right? You don't understand.
Right.
Stocks, bonds, and all that type of stuff. The stock market is a casino. That's all it is. You got the CNBC and the talking heads that are talking, well, the earnings are this and book value is this and all that type of stuff. It doesn't mean shit. The price of the stock is what a person is willing to pay for it. So if it's pumped out on CNBC or somebody says that I'm shorting this or if it's talked about a lot, it's going to have a lot more movement. And there are some technical guidelines that you can kind of watch and see, okay, hey, maybe this isn't the best time to be buying right now because of all these technical, aspects that are coming out. But that can change. Just because the technical charts are saying this, something could flip, especially in this day and age. I mean, when you look at Reddit, what happened with that whole debacle. Things can just happen.
In case I don't know what you're talking about, what happened with the Reddit debacle?
So hedge funds got mad because what they do on a regular basis, there's now these guys who were financial professionals
on Reddit.
Yeah, and they just pretended like they were just regular trading guys, but they just started a trend of talking about things, saying, hey, let's buy GameStop. Let's do this. Let's do this. Let's do it. And it started snowballing and catching traction. So GameStop, nothing happened on what they did on a regular basis. Their business model was tanking and all that type of stuff. But because it was trending and people were like, oh my God, yeah, look. I mean, yes, people were shorting it. The hedge funds were shorting it. So that's why they were going after it. Because it's like, okay, the hedge funds are trying to win, type of thing. And we're going to, win instead. But the fundamental aspect of the company did not change. So the stock price shot up because all these people bought it because they were seeing they were screwing over the hedge funds. So that's what I'm saying. It's a casino. It's all about what type of mentality is going on for that specific stock. So when I say what makes you better at picking than me, yes, I have a little more knowledge in that regards. But just because I know all the technical charts, I feel like this is doing this, I got the experience and everything, and I say, okay, we're going to buy here. That might not happen. It might tank. It might rise up and go down. So my luck or odds of doing that are just as good as yours. With maybe a little more experience in the back end. And that's where the long-term aspect, you hear about long-term investors and all that type of stuff. The long-term, yes, it's better to work with somebody because they're going to, maybe see things that are not. Case in point, current market conditions. We've been sounding the alarm for a while, talking about inflection points. We've been on a 13-year bull run. It's maybe a good time to start taking some chips off the table. So in that regards, we're giving you guidance in that way. It benefits you. But if all they're doing is putting you in, target date funds, putting you in mutual funds, all that type of stuff, it's not benefiting you any more than you going in and doing that same type of thing. You going out and opening that Fidelity account where sure, they're making money off of the mutual fund fees and all that type of stuff. It's going beyond just doing that type of stuff where a financial advisor adds value. And that's kind of what I was getting at, at the topic. It's if they're just going to give you, because you could come to my office and if I was in the big box houses and I could give you, your report saying, this is what I recommend for you, and it's 20 different mutual funds. Well, guess what? The person after you, I'm going to pull out the same report. I'm going to put on the file, put their name on it, be like, here's what I recommend for you. That's all it is. It's what they do. So, and that's the stigma that people need to get by. It's in my opinion, it's better if you're going to go to a big box house. I would say just put the money, open a Fidelity account, and put your money in the Spider Index. And
Index.
Yep, the SPY, and just let it ride. And not, again, this is not a recommendation to, buy stocks or anything like that. I'm just saying you're just buy and hold type of deal. You're going to perform better than somebody who is trading stocks for you or buying mutual funds, selling, and kind of manipulating your portfolio. It's been, statistic after statistic that does better than somebody actively managing your portfolio. But if you need something bigger than that or want to learn more beyond that, going to a smaller kind of financial firm is going to have a little bit more options.
Smaller rather than the big
box houses.
God, let's see if I even know the names. You just said it. Fidelity? Is that a name?
Did I say one?
I think you
it
said
probably slipped out. Yeah.
Spider something.
Well, the Spider. Yeah, that's a name of a
index.
Yeah, an investment. Yeah. But yeah, you got Fidelity, you got Morgan Stanley, you got Edward Jones, you got Vanguard. They're all the same. It's all the same.
Is there a difference between the big and smalls other than size?
Again, it depends. Typically, yes. But then there's the small firms out there that are just mainly stocks, bonds, and mutual funds.
Which is what the big boys do.
Right.
I gotcha.
But there's most of the small firms understand the value of other things. And they might not, teach about insurance, teach about taxes, teach about estate planning and asset protection, but at least they're going to give you a little bit more of kind of options than just the Fidelities, the Edward Jones guys.
Totally.